What happens to IRS debt after someone dies? Have you ever wondered what happens to tax debts when someone passes away? This is an important topic that affects many families. When a person dies, any outstanding tax debt owed to the Internal Revenue Service does not simply vanish. Instead, the responsibility for that debt typically shifts to the deceased person's estate. The estate consists of all the assets and liabilities of the deceased. Before any inheritance can be distributed to heirs or beneficiaries, the Internal Revenue Service must be paid from the estate's funds. First, let's talk about the estate's responsibility. The estate is tasked with settling any unpaid tax liabilities. This includes income taxes owed up until the date of death, as well as any previous unpaid taxes. The executor or personal representative of the estate must file the deceased final income tax return. This return covers income earned up to the date of death, and any taxes due must be paid from the estate's assets. Next, if the estate's value exceeds certain thresholds, the executor must file an estate tax return. Estate taxes are different from income taxes and are assessed on the transfer of wealth from the deceased to their heirs. These taxes must also be paid from the estate before any distribution to beneficiaries. Now, what about the surviving spouse? If the deceased filed joint tax returns with a spouse, the surviving spouse is still personally liable for any unpaid tax debt on those returns. This liability does not decrease or split due to the spouse's death. However, the surviving spouse may look into options like offers in compromise or currently not collectible status if they cannot afford to pay. Generally, heirs and beneficiaries do not inherit the deceased tax debts directly. They receive assets only after the estate has settled all debts, including those owed to the Internal Revenue Service. However, in community property states, a surviving spouse may be responsible for some tax debts incurred during the marriage. The Internal Revenue Service can pursue collection of tax debts from the estate for up to 10 years or longer in some cases. This means the debt remains enforceable for a significant period after death. If the Internal Revenue Service has placed tax liens on the deceased property, these liens remain attached to the property. They must be resolved before the estate can transfer ownership or distribute assets. From a bankruptcy perspective, while bankruptcy can eliminate many types of debts for living individuals, it does not apply after death. The deceased estate is a separate legal entity responsible for paying debts, including tax debts, before any distribution to heirs. If the estate does not have enough assets to cover the tax debt, the Internal Revenue Service generally cannot pursue heirs or beneficiaries for the remaining balance, except in specific situations like community property laws or joint liability. In practice, managing tax debt after death involves careful estate administration. This includes filing all necessary tax returns, notifying the Internal Revenue Service of the death, and prioritizing tax debt payments from estate assets. Executors should seek professional advice to navigate these obligations and explore any relief options available to the estate or surviving spouse.